How Ray Dalio predicted every crisis and built the world's largest hedge fund. On August 1982, Ray Dalio, a 33-year-old hedge fund manager operating out of his two-bedroom apartment in New York City, appeared on Wall Street Week, one of the most watched financial television programs in America, and made a prediction that would define his career and nearly destroy him. With absolute confidence, speaking to millions of viewers and some of the most influential investors in the world, Ray declared that the U.S. economy was heading into a depression, that debt levels were unsustainable, that Latin American countries were going to default on their loans, that banks were going to collapse, and that everyone should be preparing for the worst economic crisis since the Great Depression. He wasn't hedging, wasn't saying maybe or possibly. He was certain, emphatic, warning anyone who would listen that catastrophe was imminent. And Ray Dalio was completely, spectacularly, career-endingly wrong. What actually happened was the exact opposite of what he predicted. Instead of a depression, the U.S. economy entered one of the longest bull markets in history. Stocks soared, the economy boomed, and Ray Dalio, who had bet everything on his prediction, who had positioned his fund for crisis, who had told all his clients that disaster was coming, lost everything. His fund collapsed. He had to fire everyone, including his employees, had to borrow $4,000 from his father to pay bills. Went from managing money for institutional clients to being broke in his apartment with a wife and 2 kids to support, and the humiliation was total. He had been wrong on national television, wrong in the most public way possible, and everyone on Wall Street knew it, and his career should have been over. Another cautious investor who predicted doom and got crushed when markets rallied. But here's what makes Ray Dalio's story absolutely extraordinary. That failure, that complete and public disaster, didn't end his career, it transformed him, forced him to completely rethink how he approached investing and decision-making, led him to develop principles and systems that would eventually make him one of the most successful investors in history, because Ray Dalio came back from being broke in 1982 to building Bridgewater Associates into the largest hedge fund in the world, managing over $150 billion at its peak, returning more money to investors than any hedge fund in history, over $58 billion in cumulative gains, becoming worth personally over $20 billion, and most incredibly, after being catastrophically wrong in 1982, he became eerily accurate at predicting every major financial crisis that followed. He predicted the 2000 dot-com crash. He predicted the 2008 financial crisis. His fund made money in 2008 while almost everyone else was getting destroyed, and he did it all by learning from failure, by building systems to counteract his own biases and overconfidence, by creating what he calls radical transparency and idea meritocracy, where the best ideas win regardless of who has them, and his journey from broke and humiliated to managing $150 billion is not just a comeback story, it's a masterclass in learning from failure, in systematic thinking, in building institutions that outlast individuals, and in understanding that being right isn't about confidence or charisma. It's about having processes that force you to confront reality even when reality contradicts what you want to believe. Let me take you back to the beginning, because Ray Dalio wasn't born into wealth or Wall Street connections. He grew up in a middle-class family in Queens, New York. His father was a jazz musician who played at nightclubs. His mother was a homemaker, and Ray was a completely average student, got C's in school, wasn't particularly academically driven, but he got interested in investing at age 12 when he started caddying at a local golf club. He would overhear successful businessmen talking about stocks while playing golf, and he took $300 he'd earned from caddying and bought shares in Northeast Airlines because it was the only company he'd heard of that was trading for less than $5 a share. And purely by luck, the airline got acquired and his stock tripled, and that early success, that beginner's luck, hooked him on investing, made him think he had a gift for picking stocks, and he started reading everything he could about markets, studying annual reports, tracking stocks, and this passion for investing, which started as a middle school kid looking for easy money, eventually led him to study finance at Long Island University, get an MBA from Harvard Business School, and start working on Wall Street in the early 1970s. Ray worked as a commodities trader and then as a director of commodities at a small brokerage firm. But he was restless, thought he could do better on his own, and in 1975, at age 26, he founded Bridgewater Associates from his two-bedroom apartment. And initially it wasn't really a hedge fund, it was more of a consulting firm that advised institutional clients on currency and bond markets. Ray would write research reports, make recommendations, help clients hedge their exposures, and he was good at it. Clients valued his analysis and his willingness to go against conventional wisdom, and slowly he started managing a little bit of money, running actual positions for clients, and the business grew modestly through the late 1970s and early 1980s. Ray hired a few employees, moved out of his apartment into a small office, and was making a living, not getting rich but doing okay, building a reputation as someone who understood macroeconomics and wasn't afraid to make bold calls. And then came 1982 and the bold call that nearly destroyed him. Ray had been watching debt levels in Latin American countries, particularly Mexico, and he was convinced that these countries had borrowed too much, that they wouldn't be able to service their debts, and that defaults were coming, and if Latin American countries defaulted, U.S. banks that had lent them money would take massive losses, and this would trigger a banking crisis, which would trigger an economic crisis, which would spiral into a depression. The logic seemed airtight to Ray, the debt levels were unsustainable, the math didn't work, and when Mexico announced in August 1982 that it couldn't pay its debts, Ray thought he had been vindicated, thought this was the beginning of the crisis he had predicted, and he went on Wall Street Week and told everyone that depression was coming, that this was just the start, and he positioned his fund accordingly, buying treasury bonds as a safe haven, shorting stocks, preparing for economic collapse. But what Ray didn't understand, what he completely missed, was that the Federal Reserve under Paul Volcker, who had been fighting inflation by keeping interest rates high and tight, was about to pivot, was about to start cutting rates aggressively to stimulate the economy and prevent the Mexican default from spreading. And when the Fed cut rates, when they made it clear they would support the banking system, markets didn't collapse. They rallied, and they rallied hard. Stocks surged, bonds rallied, the economy recovered, and Ray's fund, which was positioned for depression, got crushed. His predictions were wrong, his positions lost money, and his clients, understandably, wanted their money back. Why would they keep their money with someone who had just been catastrophically wrong on national television, who had told them to prepare for depression when what actually happened was a boom? And Ray couldn't really argue with them. He had been wrong, not just a little wrong, but completely wrong, wrong about the direction, wrong about the magnitude, wrong about the timing, wrong about everything. So Ray shut down the fund, fired his employees, and found himself at 33 years old, basically starting over. He had a wife, 2 young children, a mortgage, and $4,000 borrowed from his father, and this was rock bottom. This was the moment when most people would give up, would go get a regular job, would decide that maybe they're not cut out for managing money. But Ray had something, some combination of resilience and intellectual curiosity and refusal to accept defeat, that made him dig deeper into what had gone wrong, not just to blame bad luck or unforeseen circumstances, but to really understand why he had been so wrong when he had been so confident. And what Ray realized, what became the foundation of everything he would build afterward, was that his confidence had been the problem. He had been so sure he was right that he hadn't seriously considered alternatives, hadn't stress-tested his assumptions, hadn't built in safeguards against his own overconfidence. He had fallen in love with his narrative about debt and depression and had ignored or dismissed evidence that contradicted his view, and this realization that being smart and well-informed and hardworking wasn't enough, that you also needed systems to protect you from your own psychology, from your own biases and blind spots. This became the core insight that would eventually make him one of the most successful investors in history. Ray started rebuilding, went back to consulting work, advising clients on currency and bond markets, and he started implementing the lessons from his failure. He began writing down principles, rules for how to think about markets and make decisions, and most importantly, he started building what he called radical transparency. A system where everyone on his team could challenge everyone else's ideas regardless of hierarchy or seniority, where the goal wasn't to be right or to win arguments, but to find truth, to get to the best answer by subjecting every idea to rigorous debate and criticism. And this was profoundly uncomfortable, meant that Ray himself would be challenged constantly, would have junior employees telling him his ideas were wrong, but he forced himself to embrace it because he remembered 1982, remembered what overconfidence had cost him, and he was determined never to make that mistake again. He also started developing systematic trading strategies, building computer models that would make decisions based on historical patterns and correlations rather than his gut feelings or narratives. Because computers don't have egos, don't fall in love with their predictions, don't ignore evidence that contradicts what they want to believe, and while Ray didn't abandon fundamental analysis or qualitative judgment, he built systems that would force him to consider quantitative signals even when they contradicted his intuition. Through the late 1980s and 1990s, Bridgewater grew steadily. Ray focused on institutional clients, pension funds, and endowments, offering them research and risk management services, and eventually managing money for them in what became the Pure Alpha Fund, which aimed to generate returns regardless of whether markets went up or down by taking long and short positions across multiple asset classes. And the performance was good, consistent positive returns, low correlation to stock market movements, exactly what institutional investors wanted, and Bridgewater's assets under management grew from millions to hundreds of millions to billions, and Ray's reputation was gradually rehabilitated. The disaster of 1982 faded into history, became a footnote, a cautionary tale that Ray himself would tell to illustrate the importance of humility and systematic thinking. But it didn't define him anymore. What defined him was his track record since then, his ability to navigate different market environments, his systematic approach, his principles. And then came the late 1990s, and Ray started seeing something that worried him: the dot-com bubble, stock valuations that made no sense, companies with no earnings trading at astronomical multiples, day traders getting rich. And Ray remembered 1982, remembered that feeling of being certain that markets were wrong and were about to crash. But this time he approached it differently. He didn't go on television and predict doom with absolute confidence. He built positions gradually, hedged his bets, made sure that if he was wrong again, it wouldn't destroy the fund. And when the dot-com bubble burst in 2000 to 2002, Bridgewater made money while many hedge funds and investors got crushed. But Ray didn't crow about being right, didn't write victory laps. He just quietly noted that the systems worked, that the principles worked, that radical transparency and systematic thinking had helped him navigate a major market dislocation successfully. But the real test came in 2007 and 2008 because Ray started seeing patterns that reminded him of 1982, debt levels that were unsustainable, a housing bubble built on subprime mortgages, financial engineering that was obscuring risk, and all the same overconfidence from the financial industry, all the same assumptions that everything would be fine because it had always been fine. And Ray and his team at Bridgewater started building a detailed analysis of what they called the debt supercycle. The idea that developed economies had been accumulating debt for decades, that this debt had fueled growth but was now reaching levels where it couldn't be sustained, and that a major deleveraging was coming, a financial crisis that would be bigger than anything since the Great Depression. And this time, because of the systems they had built, because of radical transparency and systematic analysis, Bridgewater wasn't just making a prediction, they were laying out the mechanism, the sequence of events, what would break first, how it would spread, what the government responses would be, and they were positioning the portfolio to profit from these developments while also hedging against being wrong. In October 2007, Ray wrote a memo to Bridgewater's clients titled "The Big Picture," laying out his case for why a major financial crisis was coming, explaining the mechanics of how the subprime mortgage market would collapse, how this would spread to the banking system, how deleveraging would cause asset prices to fall across the board, and what the Federal Reserve and Treasury would do in response. And this wasn't a one-page memo saying, "Markets will crash." This was a detailed, systematic analysis with timelines and magnitudes and specific predictions, and he sent it to clients not to scare them but to prepare them, to explain how Bridgewater was positioned and why, and most importantly, to subject his own thinking to scrutiny, to invite clients to poke holes in his analysis, to find the flaws, because Ray had learned from 1982 that confidence without scrutiny is dangerous. And then everything happened exactly as Ray had predicted. Bear Stearns collapsed in March 2008. Lehman Brothers filed for bankruptcy in September. The credit markets froze, stock markets crashed, and the global financial system came within hours of complete meltdown. And while most hedge funds lost money in 2008, many losing 30%, 40%, 50% or more, Bridgewater's Pure Alpha Fund made 14%, not just surviving the worst financial crisis since the Great Depression but actually making money for its investors. And this wasn't luck. This was the culmination of 25 years of learning from failure, of building systems and principles, of forcing himself and his team to confront reality even when reality was uncomfortable, and the performance in 2008 was vindication, not just for Ray personally but for the entire approach he had built since 1982, proof that radical transparency and systematic thinking and humility about your own limitations could give you an edge even in the most chaotic markets. After 2008, Bridgewater entered a new phase. Assets under management grew from about $80 billion before the crisis to over $150 billion by 2018, making it the largest hedge fund in the world, and Ray's personal wealth grew to over $20 billion, putting him on Forbes' Billionaire list, and his influence extended beyond just managing money. He became a thought leader, writing extensively about economics and deleveraging and how central banks work, testifying before Congress, meeting with policymakers, and his insights were taken seriously because he had been right when almost everyone else was wrong, had made money in 2008 when almost everyone else lost money, and people wanted to understand how he thought, what his principles were, what his systems looked like. In 2011, Ray started writing down his principles more formally, literally creating a document called Principles that laid out his philosophy for life and work and investing, and he shared this document publicly, initially just on Bridgewater's website, and it went viral in certain circles. Entrepreneurs and investors and business leaders reading it and finding wisdom in Ray's systematic approach to decision-making. His emphasis on radical transparency, his idea of believability-weighted decision-making, where you should weight people's opinions based on their track record and expertise in the specific area being discussed, not on their seniority or charisma. And in 2017, Ray published Principles as a book, which became a New York Times bestseller. And suddenly Ray Dalio wasn't just a successful hedge fund manager. He was a guru, a philosopher, someone whose ideas about systems and decision-making and organizational culture were influencing people far beyond finance. But Ray's success and influence also brought criticism and controversy. Bridgewater's culture of radical transparency, which Ray saw as the key to the firm's success, was described by some former employees as brutal, cult-like, psychologically damaging. There were stories of meetings where employees would be publicly criticized for hours, where every interaction was recorded and could be played back and analyzed, where people felt they couldn't trust anyone because anything they said might be used against them later. And while some people thrived in this environment, found it liberating and intellectually stimulating, others found it toxic, and the employee turnover at Bridgewater was notably high, with many people leaving after a few years because they couldn't handle the intensity of the culture. And Ray defended the culture fiercely, said that radical transparency was hard but necessary, that if you couldn't handle having your ideas challenged, if you needed to have your ego protected, then Bridgewater wasn't the right place for you, but that for people who could handle it, it created an environment where truth prevailed over politics, where the best ideas won regardless of who had them. There were also questions about Bridgewater's performance in the years after 2008. The Pure Alpha Fund had some good years but also some mediocre years, and critics pointed out that while Bridgewater had been spectacularly right about the 2008 crisis, they had been less successful in predicting or profiting from subsequent market moves. They had been bearish for much of the 2010s, expecting another crisis, expecting the deleveraging to continue, but instead central banks printed massive amounts of money, kept interest rates at zero, and markets rallied for over a decade, and Bridgewater's returns during this period were good but not spectacular. Solid but not what you'd expect from the world's largest and supposedly most sophisticated hedge fund, and assets under management actually declined from the peak of $150 billion to around $120 billion as some clients withdrew money, and there were questions about whether Ray's macro approach, which had worked brilliantly in 2008, was still effective in a world of unconventional monetary policy and zero interest rates. Ray also became more political and public in ways that some clients found uncomfortable. He developed a close relationship with China, visiting frequently, meeting with Chinese leaders, and writing extensively about how China's system was effective and how the West could learn from China's approach. And this was controversial, particularly as U.S.-China relations deteriorated and as China became more authoritarian, and some people accused Ray of being naive about China, of being seduced by access to Chinese leaders, of not seeing or not caring about human rights issues, and Ray defended his views, said he was just being objective, just analyzing China's economic system without imposing Western values. But the criticism persisted, and it raised questions about whether Ray's principles, which emphasized radical truth and transparency, applied differently when dealing with an authoritarian government that wasn't transparent and didn't tolerate dissent. In 2020 and 2021, Ray began transitioning out of day-to-day management of Bridgewater, handing over the CEO role to others and focusing more on mentoring and writing, and there were concerns about succession, about whether Bridgewater's culture and performance could be maintained without Ray at the helm, whether the principles and systems he had built were truly institutional or were dependent on his personal leadership. And these are questions that won't be answered for years, but they're important because they get at the core of what Ray built. Is Bridgewater just Ray Dalio plus systems, or is it an institution that can outlast him? And the answer will determine Ray's ultimate legacy, whether he built something that lasts or whether Bridgewater eventually becomes just another hedge fund that rises and falls with its founder. But regardless of what happens to Bridgewater after Ray, his personal story, the arc from broke and humiliated in 1982 to managing $150 billion and being worth $20 billion, is extraordinary and offers lessons that extend far beyond investing. First and most obviously, failure isn't final. Ray's career should have been over in 1982. He had failed in the most public way possible, lost all his clients' money, including his own, had to start over from zero, but he didn't quit, he learned, and the learning transformed him from someone who was confident and charismatic but ultimately wrong into someone who was systematic and humble but ultimately successful. The failure was the best thing that ever happened to him because it forced him to confront his own limitations and build systems to compensate for them. Second, being right isn't about confidence, it's about process. Ray was incredibly confident in 1982 and was completely wrong. He was much more uncertain in 2007 but had better processes and was right. And the difference was that in 2007 he had systems that forced him to test his assumptions, to consider alternatives, to hedge his bets. The lesson isn't that you should never be confident, it's that confidence without systematic thinking is dangerous, that you need processes that protect you from your own psychology, from your tendency to see what you want to see and ignore evidence that contradicts your narrative. Third, radical transparency and idea meritocracy, while uncomfortable and not for everyone, can create environments where better decisions get made. The reason Bridgewater succeeded where so many hedge funds failed isn't that Ray Dalio was smarter than other hedge fund managers, many of whom also went to Harvard and had successful track records. It's that Bridgewater had systems that forced ideas to be debated rigorously, that allowed junior employees to challenge senior employees, that rewarded people for finding flaws in others' thinking rather than for being agreeable or maintaining harmony. And while this culture was intense and caused high turnover, it also meant that bad ideas got killed early rather than being implemented because someone senior supported them. And in investing, killing bad ideas before they lose money is often more important than finding good ideas. Fourth, systems matter more than individuals. One of Ray's core insights was that you can't rely on any individual, including yourself, to always make good decisions. People have biases, blind spots, bad days, ego issues, but systems, if designed well, can compensate for individual limitations, can force consideration of factors that individuals might ignore, can aggregate information and perspectives in ways that lead to better outcomes than any single person could achieve. And this insight, which Ray developed after his failure in 1982, is what allowed him to build an organization that could manage $150 billion and navigate multiple financial crises successfully, not because Ray was a genius, but because the systems he built were robust. Fifth, learning from other people's mistakes isn't enough. You need to learn from your own. Ray had read about the Great Depression, had studied financial history, knew intellectually that overconfidence was dangerous, but he didn't really internalize the lesson until he lived through his own failure, until he personally experienced what it feels like to be catastrophically wrong when you were certain you were right, and that personal experience, that emotional and financial pain, created a level of commitment to humility and systematic thinking that intellectual understanding alone never could have. Sometimes you need to fail personally, need to feel the consequences before the lesson truly sinks in. And finally, success isn't just about making money, it's about building something that matters. Ray Dalio could have spent his career just managing money, making himself and his investors richer, and that would have been a successful career by any normal measure, but he aimed higher, tried to build systems and principles that could outlast him, tried to share what he learned so others could benefit, wrote books and gave speeches and mentored people. And while some of this was certainly ego-driven, while Ray clearly enjoys being seen as a sage and thought leader, it also reflects a genuine desire to contribute something beyond just returns, to build something institutional, to create knowledge and systems that have value independent of his personal presence. And whether he succeeded in that larger ambition, whether Bridgewater and his principles outlast him, remains to be seen, but the ambition itself, the desire to build something bigger than yourself, is worth admiring. The question of Ray Dalio's ultimate legacy is complicated because he's still alive, still influential, and Bridgewater is still operating. We don't yet know how the story ends. Will Bridgewater continue to thrive without him, proving that the systems and culture he built are truly institutional, or will it fade like so many hedge funds that rise and fall with their founders? Will his principles continue to influence how organizations think about decision-making and transparency, or will they be seen as specific to a particular time and culture and not broadly applicable? Will his views on China age well or poorly as China's story continues to unfold? And will the criticisms about Bridgewater's culture, about the psychological cost of radical transparency, ultimately overshadow the financial success and intellectual contributions? These are all open questions. But what we can say with certainty is that Ray Dalio's journey from broke and humiliated in 1982 to managing $150 billion and being worth $20 billion is one of the great comeback stories in financial history, that his systematic approach to investing and decision-making, developed as a direct response to catastrophic failure, produced remarkable results over multiple decades and multiple crisis periods, that his emphasis on radical transparency and idea meritocracy, while controversial and intense, created an organizational culture that allowed Bridgewater to become and remain the largest hedge fund in the world, and that his willingness to share his principles and insights publicly, to be transparent about his own failures and limitations, has influenced how many people think about decision-making and organizational design far beyond just investing. So the next time you fail, the next time you're certain you're right and turn out to be completely wrong, the next time you experience that sinking feeling of public humiliation and professional disaster, remember Ray Dalio in 1982. Remember that he borrowed $4,000 from his father and had to start over at 33. Remember that he could have given up, could have concluded he wasn't cut out for investing, could have gotten a regular job and lived a comfortable but unremarkable life, but instead he chose to learn, chose to dig deep into why he had been wrong, chose to build systems that would protect him from his own limitations, and that choice, that response to failure, ultimately led him to build one of the most successful investment firms in history, to manage more money than almost anyone ever has, to influence how organizations think about decision-making and transparency, and to demonstrate that sometimes the best thing that can happen to you is to fail completely publicly, painfully early enough in your career that you have time to learn from it, to rebuild based on what you learned, and to come back stronger, more humble, more systematic, and ultimately more successful than you ever could have been if you had succeeded easily from the start. Because easy success teaches you that you're special, that your gut is always right, that confidence equals correctness, but failure, real failure, failure that costs you everything, teaches you the much more valuable lesson that you're not special, that your gut is often wrong, that confidence without systems is dangerous, and that the path to lasting success isn't through being the smartest or most confident person in the room, but through building processes and principles and systems that make good decisions regardless of who's making them. And that legacy, that lesson, might be worth more than all the billions Ray Dalio made or managed, because money comes and goes, but wisdom about how to think and decide and build institutions, that's something that can compound and grow and influence people for generations.